Hello, and thank you for joining us tonight for our Ready, Set, Retire seminar. My name's John Mulcahy and I'm the Advice Manager at LGIAsuper. And we're also joined tonight by Troy Rieck, the Chief Investment Officer at LGIAsuper, and I look forward to introducing you to Troy very shortly. Well, what a year we're having. It's almost like we've all been jammed onto a roller coaster and getting thrown every which way with no clear idea when the ride's going to end. And if you're anything like me, you don't particularly like roller coasters. That's not a lot of fun. And it'd be understandable if all this uncertainty is creating a bit of concern to you in terms of what does this mean for my super and maybe eventual retirement. And while neither Troy or myself will pretend to be able to see into the future, what we hope to be able to do tonight is to share information with you to help you make good decisions and feel more comfortable about how you're positioned now and leading into retirement. So just before we get started, a word of warning. Many of you out there will be at a similar stage of life perhaps and have similar goals for your super. But you are all different, and therefore we can't just sit here and say, look, this is what you should do, A, B and C. So what tonight's about is giving you a range of information and opportunities, but you definitely need to apply that to your own circumstances to see what the right thing to do is for you. And having said that, the last thing we want to do is just throw a lot of information at you and leave you alone. We'll also point out how we can help you to make the most of that information. Following this evening's presentation, we'll send you an email with a link to a workbook, so something that will contain certain pieces of information that we share with you tonight so that you can reflect on that at your leisure. Also, we'll include a few questions maybe to challenge you on how familiar you are with your super at the moment and give you some things that what you should be thinking about and a small checklist to point you in the right direction. Now, even though you can't be with us tonight, we certainly want to hear from you, and so on your screen there should be a range of icons. One of those is a blue hand, so please feel free to at any stage use that to send through a question to us. And at various stages tonight, we will check in and look to answer questions. If we get more than we can handle, rest assured we will follow through and respond to you personally in the coming days. And joining us tonight is a fantastic start, but certainly what's more important is the action you take after tonight with that information. So I really applaud you for joining us and hope that you take the next step after tonight as well. You should be able to follow with slides, so depending on what device you're using, they should appear either next to the speaker's image or possibly below, so maybe just adjust the screen if you need to so you can be following along with the information as we speak. So let's get started. Some of the common questions that our team of advisors get asked are things like, how much do I need to retire, or have I got enough to retire? Will I be entitled to anything from the government? And how should I be investing my super either now or when I retire? And you've joined us tonight, so there's every chance these questions are on your mind as well. And really that's what tonight's about, for us to be able to share information that will cover off on these broad topics and help you feel more comfortable about the decisions you're making and the opportunities that might exist. So where do we start? Well, as financial advisors, really we sort of start at the end. And that's because we want a clear picture of what it is that you want to achieve for your retirement so that we can then work out what that means you're going to need, come back to the present to see where you're at now and what you might need to do to get there. And so with that in mind, I thought we might share a few images of your fellow LGIAsuper members who have already retired, maybe to inspire you or motivate you, although many of you probably don't need any extra motivation to be looking forward to retirement. But these are genuine members, and these are very typical of the things our team hear that you are likely to want to enjoy in retirement. And as you can see, they're themes like spending time with family, certainly travel. You might notice here quite a few like overseas, which clearly a lot of those plans have been hit on the head at the moment, and hopefully not for too much longer. But certainly walking, travel domestically as well. And for this couple, staying healthy and fit in retirement so that they can enjoy the travel and those sort of activities is very important. The picture with the helicopter, they actually took that over the Grand Canyon and had a great time there. Luckily they got that in. Obviously they won't be occurring too soon, but hopefully that helps to give an idea and inspires you. But the other point I'd like to make though is it's great, and often you do have these big ticket items or things that you're really looking forward to doing in retirement, and that's great. But possibly more important is thinking about the day-to-day when you get to retirement. So what are you going to replace that 40-odd hours every week that currently spent with going to work with something that's meaningful and so rather than the mundane? Because I guess one of the traps there, or what can make retirement even harder, is to get there and not have that fulfilment, I guess. And you might know people who've tried retirement and ended up back at work, and often that's the reason for that, because they probably didn't give it adequate thought beforehand. So in terms of where we start, we thought we'd look at a couple of retirement lifestyles for you, and the first one we'll look at here is Jack. Jack we'll look at from ages 60 to 65. He's a single gentleman, likes to keep life fairly simple. He's not interested in world travel or having a shed full of toys. And we tend to call that lifestyle a modest lifestyle in retirement. But what does that mean? Now, we tend to say to our members, the best way to prepare for retirement really is to understand what you're spending now on life, and then what's going to change as you move into retirement. So what would change with your costs? So that's probably the best way to get an idea of how much you're going to need each year or each week in retirement. But if you're not already a great budgeter and have a clear idea of that, then ASFA do some work to help us out with this. Now, ASFA is the Association of Superannuation Funds of Australia, and each quarter they survey retirees to get a feel for, or actual figures for, what retirees are spending now in retirement. So what we've got here, and these figures are in the workbook that you'll receive as well. So for a single and a couple, and the workbook will break that down in more detail for you as to what those figures are composed of. But like the images suggest, and as I mentioned before, it's typically the simpler things in life, and there's certainly nothing wrong with that. Now, we'll also look at Tom and Sophie this evening, and they want a slightly different approach. They'd like a little bit more in retirement than what a modest lifestyle might offer. And there's every chance that you might relate to that as well. Yep, I'm sure there'll be a few heads nodding wherever you're watching. And certainly over the years, I've had a number of clients who've retired and been happy and on a modest income in retirement, but certainly the majority of people we talk to would like to have that little bit extra. So what does that look like? So once again, ASFA also do numbers for us on what a comfortable retirement might look like. And those numbers you can see are roughly about an extra $16,000 a year for a single and about $22,000 a year for a couple. So not an insignificant amount of money, and therefore joining us and starting the planning is certainly a good idea. So for Tom and Sophie, it's travel. We saw them at the train station. But for you, it might be home comforts. It might be entertainment, maintaining a better car or caravan, whatever matches the lifestyle that you're looking for. And so that's really where you should start. How am I going to spend my time? From there, you can put together that weekly or yearly income that's going to be needed in retirement. Because once we know that, we can then work back to now to see or work out how much you're going to need based on when you plan to retire. So to try and give a guide on that, we've done a little bit of work. So on this slide, what we've looked at is for both singles and couples, how much you might need to be able to achieve that comfortable retirement, either with Centrelink assistance or by self-funding. Now, which one should you focus on? That probably depends on how old are you now. If you're going to retire soon and reasonably close to your pension age, then I think it is reasonable to probably rely on the figures we've got with Centrelink numbers. Retirement ages at the moment, 66, 66 and a half, and 67, depending on what year you were born. But if you've still got a way to go before you plan to retire, then we would suggest that maybe those self-funded figures might be better ones for you to focus on. Why? Well, let's see, someone who's 50, who might be planning to work till 67, 17 years, 17 federal budgets. So we generally say, how confident can you be over such a period of time that the age pension is still going to look exactly like it does now? And I guess throw into the mix the possible medium and long-term impacts of coronavirus and measures and the like. I guess that possibly adds some more uncertainty. So the more time you've got, the more we would encourage you to control the things you can control, and that's your wealth creation. Now, just before Oh, and I guess a couple of other factors there too. So you might want to retire earlier than pension age. Then that probably also extends that funding period you're looking at, which means you might need a little bit more. Or it might be important to you to leave money or assets behind for family or for the estate. No, more probably head shaking this time, and that's fine as well. My father put me out of the will back when I was about 16 when I got taller than him, so I've had no expectations for a long time now. Before I move on, a couple of assumptions around this. What we're looking at here is for couples, so $62,000 a year, and for singles about $44,000 a year, and funding of a period of 20 years. So the typical retired 67 and going through to 87, so approximate life expectancy there. We're also assuming that there'll be no investment funds left, so if you're a homeowner, you'll still own your home, but all the investment assets are super used up through that time frame. So if you're still going, if you've spent that, you'd be on age pension only. And an investment, a sort of middle of the road investment style of medium or balanced type of investing. So with that, we might just round out the first section there and check for some questions. So at the moment we don't have questions, so we'll keep moving. Before I do so though, I would just like to welcome any newcomers who've joined us since the start. Much appreciated. If you would like to ask questions as we go along, there is a blue icon that is you're able to use to send questions through. And yeah, and so to move on to the next section, so what we've looked at is how much do I need to retire, and so the next piece is how do we get there. And for many people, superannuation might be that joining piece or missing piece of the puzzle. And even though the government does a very good job of complicating super for us, it's really a pretty simple thing, because how much you have at the end is really just based on two things: how much you put in and how you invest it. So let's consider that investment piece of the puzzle now. So I'll take the opportunity now to introduce you to Troy, our Chief Investment Officer. I dare say Troy hasn't probably had a good night's sleep since late February with the onset of this pandemic, and such is his concern for your retirement funds and looking after your retirement money. So with that, I'll pass over to Troy to hear what his team are doing for us. Thanks, Troy.
Thanks, John, and good evening, everyone, and thank you for your time. I've prepared slides for this evening's presentation, but what I'd really like to do is to answer your questions. So as John said, if there's a topic that you'd like us to address, please click on the little blue hand at the top of the screen and send your questions on through. So we all know that COVID-19 has had a huge impact on society, the economy and financial markets as well, and also the value of your retirement savings. A human health crisis has become an economic crisis, with direct and severe impact on so many people. We've been doing a great job here in Australia flattening the curve, even including the recent outbreak in Victoria, and it's such a contrast between the experience here in Australia and many places in the world. In the left-hand chart here on the screen, you can see the experience in the US, which has had a resurgence in COVID-19 infection rates since state governors have begun to reopen the economy. We're also seeing an ongoing increase in the caseload in many emerging market economies, such as Brazil and India. One thing's for certain, COVID-19 infection rates and mortality remain a very challenging aspect of our daily lives around the world. Treasurer Josh Frydenberg today announced the largest budget deficit in Australia's history, a consequence of the government's necessary response to the economic hibernation that we've been experiencing. And when you look at this chart of unemployment, it's easy to understand where that deficit has come from. Many people and businesses out there are struggling to make ends meet, and we can only imagine what the economy would be like without the government support programs, JobSeeker, JobKeeper, and the rest. What we're seeing now is the highest unemployment rate for 20 years. And when we take into account people receiving JobKeeper but who aren't working any hours, the effective unemployment rate is greater than the recession of 1990. The effective unemployment rate reached almost 15% in April this year. That's an astronomical number. And shutdowns in the economy have damaged consumer confidence as well as the risk appetite of the average investor. And this damage can be seen most keenly in the prices that people have been paying for companies listed on share markets, both here and overseas. During February and March, share markets experienced drawdowns of 20 to 40%. The chart on the page in front of you here is the S&P 500, which experienced a peak to trough drawdown of more than 30%. And we experienced a similar fall here in Australia. This is the second fastest fall in share markets in history, leaving aside Black Monday in 1987. And this has caused understandable stress for many members. But it's clearly great news that share markets have bounced back, and bounced back hard. So much so that the US share market is now in positive territory for the calendar year to date. Here in Australia, we've also seen a hard bounce back in the ASX 200, and the economy has begun to recover as well. Now, part of the reason for that, of course, is the remarkable recovery in China, which you can see here on the chart in front of you. China remains our largest export market, and their ongoing demand for mineral exports in particular has supported our economy. The right-hand chart is the US dollar price of 62% iron ore. That's the benchmark used for pricing in iron ore. And the mineral exports that we generate through iron ore, through natural gas and other sources, generate vital revenues for businesses. They support Australian wages and they help generate tax revenues for the government. So where did we finish up for the financial year? Tonight, I'm very pleased to report to you that LGIAsuper was one of only 16 funds to have a positive return for its MySuper option. All bar one of our diversified options finished back in the black this year. Now that may not sound like a big deal, but compared to where we were towards the end of March, that's really an excellent outcome for members. You can see from the right-hand column here on the screen that it's been a challenging period for share market investors, particularly here in Australia, and for property investors. For those in the positive territory, fixed interest in international shares, we've seen small positive gains, much less so in previous years. It's a similar story, of course, for our pension options. You can see the returns for the pension options are generally higher than those for the accumulation options. And that's because, of course, members in the pension phase don't have to pay income tax on those earnings. Just like the accumulation options, the bounce back in returns has been very pleasing for our pension members, and this will help boost their retirement outcomes. Members also often ask how we're doing compared to other funds out there. To make that comparison, let's have a look at the Super Ratings survey. This one's as at 30 June 2020, and of course, all returns shown are after fees and taxes. For the year just gone, LGIAsuper's diversified options were above average returners, and the return for our balanced option in particular was number 4 in the survey for the financial year just gone, and that's a very pleasing outcome. Over longer time periods, here I've simply pictured 3 years, the story is much the same. When you invest with LGIAsuper, you're investing in a tried and tested investment strategy that's delivering above average outcomes for its members. The same's true for our pension options, but we're performing even better compared to peers here, with the aggressive, diversified growth and the balanced options in the top quartile for the financial year, and either top quartile or top of second quartile over 3 years. Pension members obviously better from this better than average performance through higher account balances, and this helps support their lifestyle and retirement. So as we enter the new financial year, a natural question to ask is, what does the next phase of the economic recovery look like, and what does this mean for financial market returns? Well, there's no avoiding the fact that a large part of the next 6 to 18 months is going to be dominated by 3 important factors. One's the US presidential election. The second is the trade tensions we see between the US and China. And the third, of course, it's COVID-19. And in particular, whether we get a vaccine or we have a second wave of infections and mortality. Now, if we do discover a vaccine in the near future and it's quickly developed and then distributed, that's a very positive outcome, and we're much more likely to see sustained pickups in economic activity around the world. And that should be very supportive for share prices. The flip side, of course, is that a delay in getting a vaccine or a continued escalation in infection rates and mortality is going to suppress demand and have a negative impact on the economy and likely a negative impact on share market prices as well. But the bigger challenge we see is the longer term picture, outside of that 6 to 18 months. We need to find a way to reinvigorate productivity growth and economic growth in the economy, not just here in Australia, but around the world. Stronger economic growth delivers better profits for businesses. It supports wages growth and employment growth. These are all things that are necessary for Australia to continue to progress. Faster growth will also boost the housing market and other economically sensitive parts of the country. Without that extra growth, it's going to be a tougher time for businesses to invest and for consumers to spend their discretionary dollars. And this does help to frame where we are in financial markets, because right now we're getting very different signals about the future economic outcomes from share markets compared to bond markets. And I'd just like to spend a couple of minutes looking at that here. If I look at share market pricing right now, investors in share markets are quite buoyant. They're saying future prospects for the economy are quite positive. They're looking beyond the current circumstances that we find ourselves in, and they're choosing to pay higher and higher prices for future profits. This apparent contradiction, rising share prices and yet we see falling earnings at the present time, comes about precisely because share market investors tend to be forward-looking. They're trying to look beyond the current circumstances out into the future, and they're forecasting much better times to come. In fact, the mood of share market investors is at risk of being perhaps a little bit too buoyant. As you can see here, this chart of the Shiller PE ratio simply talks about the price that people are paying for $1 of future profits on the share market. Now, we're close to record levels on this measure. What does that actually mean? Well, it means it's going to be tougher in the long term for share markets to generate significant capital gains, given the high prices that investors are now paying for profits. And we can see this best in the performance of a component of the share market, and in particular, the dichotomy between so-called growth stocks and value stocks in the current market. This chart from Goldman Sachs shows the performance over the last 6 months of growth stocks. Let's talk about Facebook and Google and Amazon and Apple, Microsoft, Netflix, and how strongly they've outperformed old-fashioned value stocks, industrials, mining companies, banks, and that outperformance has accelerated. Now, this is atypical behaviour coming out of a recession. Normally that boost in economic activity that you see coming out of a recession gives those value stocks a real kick along. We're not seeing that. In fact, we're seeing the reverse at the present time. Bond markets are also talking to us about a very different story to share markets. It's a message of caution about the future. What I've got on the page here is the expected return on 2 types of US government bonds. At the bottom, this is a US 10-year government bond. That's the plain vanilla standard type. But at the top of the page, I've got the return on a very different kind of bond. This one's a so-called inflation-protected bond. Expected returns from bonds are low. In fact, they're so low that investors in bonds are going to lose money once they take inflation into account. And in fact, the expected returns have continued to fall since March. And again, that's a very different outcome to what you would normally expect from an economy that's bouncing back after a recession. Expected returns for bonds are very low, but they're also very low for cash. In some places in the world, cash returns are actually negative. This isn't the world that I grew up in. I'm old enough to remember when cash and bonds used to pay such a high income, members could retire and invest in these so-called low-risk assets and simply live off that income. That would be an extremely difficult thing to do in the current circumstances. So what does that mean for us going forward and you as a member? The world faces a high degree of uncertainty about economic and financial market outcomes, and a natural question to ask is, what are we doing in response to these challenges? That is a great question, and I'd like to address it here this evening. What we're doing here at LGIAsuper is relied upon tried and tested techniques that have been put to work over decades to deal with challenging times. What am I talking about? What we're showing here is the MySuper Under 75 option, where most of our members are invested. LGIAsuper is a big believer in the benefits of diversification, spreading your risks across different types of investments. And the reason is that investment professionals will tell you that diversification works. Diversification helps to reduce the risk that you see a really bad outcome from any particular type of individual investment. The MySuper strategy that we offer members here is a growth-oriented one, but it's diversified both within the growth assets and between growth and defensive assets. Diversification provides you with the best possible chance to meet your investment goals. We're also staying focused on the long term and keeping a long-term perspective on the world. That helps us to maintain a long-term investment plan, and it minimises the risk that we make big changes in the portfolio at the worst possible time. We're also reducing fees, costs and taxes in the plan. It's always a good time to squeeze more value from the assets you already own, to reduce costs and to focus on generating returns in an after fees and taxes concept. That's always going to be a big part of the response here in the investment team. And from a member's point of view, the start of a new financial year is an ideal time to do a little health check, to review your personal circumstances, and that includes looking at your super. Members who stay informed, who ask questions and get advice, whether that advice comes from us or from another trusted advisor out there, tend to get better retirement outcomes, and they're in a better position to achieve their retirement goals. So as always, if you have any questions, please just let us know. Click on the little blue hand above, send your questions on through, because we'd love to help. Thanks again for your time this evening.
Excellent. Thanks, Troy. It's great to have Troy here, obviously, with the insight that he has and be able to share that with you. And you know, quite a frank assessment. It's not necessarily times are clear or easy, but I guess the key message is that there's a strategy and an awareness to get us through it. And so I guess you might be thinking from that, well, that's the sort of the overview of what's going on around the world and the fund as a whole. Well, what does that mean to you, or how do you apply that to your own circumstances? And I guess the first point is really understanding, well, where are you investing in? As Troy was just talking to the MySuper, if you've never made a decision, that's the option you'll be in. So it's really important to understand the nature of that, how it invests and what you should expect. But also importantly, it's not just, or LGIAsuper, we understand that one option isn't going to suit everyone. And so we do have a whole range of these diversified options, or right through from something at the aggressive end, and which has more exposure to the riskier assets. It'll be more volatile with the expectation of better long-term returns, right the way through the spectrum down to the conservative or with the defensive option at the other end. So wherever you're at, whatever your style or comfort level is, we've got an option to suit you, and that's what I'm just going to work through a little bit more with you now. It is also not necessarily just about having a single option. It might be that blending a couple of options might get the best outcome for you. And that's why we have this range. So it's all well and good to talk about names like aggressive and so forth, but what does it really mean? So what we thought we might do to try and help understand this a little bit more is look at what we might expect from various options. And so what we've got here is an outlook for the next 5 years. What might we expect to receive on average a return over that time frame? And to do this, I thought we'd use some extremes. So we've got the aggressive option, as I just described, the defensive option, and then cash. So as I said, aggressive, more volatile, or more riskier assets, more volatility, defensive, more conservative, and then cash is just like any cash you have in the bank yourself. So first thing, so what those returns are that we're expecting. So aggressive, you can see by the green rectangle, so that's about 4.9%. For defensive, we're looking around 2.4% on average, and cash at 1%. Now, what about the black dot? Well, that represents the consumer price index, or the increase in the cost of living, as Troy referred to a moment ago. And that's important because if we're not beating that, we're actually possibly going backwards. So you can see again here with the gap between the dot and the rectangle for the aggressive option that we do have a good chance of achieving what we call a real rate of return for those investments over the medium to long term. With defensive, we still expect to beat inflation over time, albeit by not as much, whereas with cash, we basically are assured of not beating inflation. So why invest in cash then? So if we broaden that to show these ranges, so what this brings in, and if there's mathematicians out there, this basically shows where 2/3 or 68% of returns are expected to fall through that time frame. So you can see with aggressive, so at the upper end with the blue box, in a good year we might expect to get about 16%, whereas in a bad year it might be as bad as around -6%. With defensive, as you can see, and like I said, because we've got less exposure to those riskier assets, that band is much narrower. So in a good year, we might expect a 5% return. And in a bad year, maybe only as bad as -1. And again, as we were saying with cash, basically the good news is there's no downside or you're not going to get a negative return, but there's also no real upside either. And in terms of cash for retirement, I often sort of use a parachuting analogy. So to me, if you're heading into retirement and you're investing your retirement money into cash, then to me that's a bit like jumping out of an aeroplane without a parachute. Why do I say that? Well, because the outcome's pretty clear, isn't it? I'm going to be travelling at very high speed and I'm going to hit the ground very high. And I'm not sure I'd enjoy the free fall very much either, knowing that's coming. And cash is the same. I know if I invest in cash, I'm going to get a low return. And as we've said, there's a real risk of losing wealth against inflation in that case. Now, investing in growth assets are like the aggressive option. That's a bit like having the parachute on. So yes, there's a chance it won't open. So in this example, there's about a 15% chance in any 1 year we might actually get a return of worse than minus 6%. But that also means there's an 85% chance of doing better than that. And we'll look at that. Now, so am I saying you shouldn't have any money in cash? Absolutely not, because the certainty of cash is what makes it so valuable for short-term needs. You have fixed expenses, rates, groceries, all those essentials. So I guess that's looking forward and that's a guess. But how can we have confidence about that we might be able to rely on those sort of assumptions? Well, to do that, I thought we could look back. So I've gone back quite a way. I've had to go back to the global financial crisis to get a period that would include some reasonable volatility, a bit like what we're going through now and might still be experiencing. So if we go back to 2009, we can see the returns for those three options. So basically the depth of the GFC, the aggressive option actually fell by 16%, so minus 16% for the return. Whereas defensive, because of its nature, actually was negative, but only just at about minus 0.6%. Whereas cash, as expected, positive return there of 3.7%. Now, what happened, these orange lines, so in 2010, we saw the world start to recover from that downturn. So aggressive bounced back quite strongly to a positive 7.6% return. Defensive even was better again at 8.6. So why was it even better than aggressive? It was sort of perfect conditions in 2010 for the defensive option. You had rising equity prices, rising share markets. At the same time, you had falling interest rates, which is great for bonds. So for a portfolio like defensive, did very well. And cash, as you can see, well, it actually did a bit worse, 2.9. Why did cash drop? Well, for the same reasons as Troy's already been alluding to. So governments and reserve banks around the world were trying to stimulate the economy to keep things going. So interest rates were actually falling through the GFC period as well. What about in 2011, the grey bar here? So further recovery, aggressive was 12.7%, defensive still solid at 6.2%, and cash very similar again at around the 4% mark. 2012, oops, a little bit of a hiccup here. You might remember in 2012, Greece was mentioned in the news almost as many times as pandemic has been used in the news this year. There was a lot of fear about Greece defaulting and what that might mean for Europe. At the same time, in the US, there was politics going on about their debt ceiling and so forth. Markets don't like uncertainty, as we're experiencing well again now. So aggressive, just negative that year. Defensive still strong at 7%, and cash more of the same. Then in 2013, the blue bar there at the top, now that's what we've been waiting for. 17.8% for aggressive. That's why we put up with the short-term pain that comes with investing in that, because we know if we hold true, the returns or the payoffs will come for us. Defensive, a more modest year at 4.8%, and cash at 3%. But really the main point I want to share with you about that is, what do you notice about the shape of that graph now with the previous one I showed you about the estimates looking forward? And it's almost identical, isn't it? Very narrow band or range for cash, slightly wider for defensive, and very wide for aggressive. So we know with reasonable expectation that that's what to expect. But I started talking about a 5-year average, so let's look at what that looks like now. So here the green bar, so that shows the 5-year average return over that period for the 3 options. Now you can see in actual fact defensive was the best performer over that time frame. And at 5.2%, aggressive and cash actually end up doing similar over that time frame. So, well, hang on, John, you just said aggressive's going to do better, and it didn't. Well, to be fair to aggressive, because of the nature of its investment, it's even not really a investment option for 5 years. It's more a 7 to 10 year or option because of the risk exposure it does have. So if we were to forget about 5 years and go out to 10 years, shown by this blue box here, we can now see that actually what we expect has happened over the longer term. So aggressive over the 10-year average, 6.7%, defensive about 2% less at 4.6%, and cash about 2% less again at 2.7%. So, well, what's the point to all this? Well, it's certainly not to say you should invest in the aggressive option, but to understand that link between volatility and returns in the short term, and we'll explore that a little bit more now, because the other thing we don't want is, or is best avoided, is reacting to these time frames. As again, Troy mentioned, that drop in February to March. If you understand why you're investing in the things you're investing for and your time frames, then you should be able to get through those without having to react too negatively. Now, where do you start? Well, probably understanding the option you're in now, and is it right for you? How do you do that? Well, I think the best place to start is time. How soon are you going to need to access that money? Because that's going to tell you how long or how much volatility those investments can be exposed to. But you also have to think about the emotional side. Like I've just been saying, it's all well and good for me to say, oh, you've got 10 years to go, so you can afford to be in the aggressive option. But that's no good if, when we go through periods like we have this year, if that's keeping you awake at night and you end up looking like this guy, then clearly that's not the right strategy for you. And as advisors, it's one of the key things that we assist our members with, is helping balance that challenge of how can I get the return I need to get on this money so it can last and give me the retirement I want, but do so with a level of volatility that I'm going to be comfortable with and be able to maintain that strategy through the testing times. So let's apply that to retirement. How do you choose appropriate strategy? Well, for me, it's, again, as I said, time frame. So if we look at here, we've got 2 key time periods. So the first one is from how old you are now until when you want to retire. And why is that important? Because that's the job, your super's only job in that time frame is to grow, okay? But sometimes people tend to give a little bit too much focus on this, and they say, well, I'm retiring in 3 years or 5 years, wherever it is, and therefore, or next year, I need to focus on that. But the danger with that is forgetting that second period, which is the likely very long, or for most of us, very long period in retirement. At this stage, people retiring in their mid-60s on average are looking at a life expectancy of plus or minus 20 years. If you've been a white-collar worker, possibly even longer. But having said that, absolutely, some of you might be very close to retirement, and it might be this year or even next year. And so you might have need to access some of this money in the very near term. So absolutely, you need to take that into account. And maybe you should have a conservative allocation for a certain amount of that money. But that's still, for most of you, not going to change the fact that most of that money you're growing in super won't be needed for 5, 10, 15 years into retirement. So still going to have a long-term time frame for that money. I'm sure if I ask the question out there, how many of you've got parents or grandparents either still alive into their 90s or even 100 or live that long, I'm sure again some of you will be sitting there knowing that you might even be watching with those parents. But and if that's the case, then longevity might be something you need to factor in as well. You know, you might have to more years than the average. And so I guess the point we're trying to make there is there's a real risk in being too conservative if you want that money to last. So really it's about understanding where you are now, what options you're in, what does that mean, and then is it right for you? So we'll just check for questions to bring this investment section to an end. And Troy, the first one is directed to you. So Ken asks a question of us. Hi Troy, how the COVID-19 will impact the share market and the options for my super in the near future? Should I be more conservative in my options for the time being? Thanks. Thanks, Ken.
Ken, thanks very much for your question, and it is a great one. I do have to start by prefacing my response by saying I'm not licensed to give you personal advice, so what I'm talking about here is purely from an investment point of view. We're very cautious about responding to changes, whether perceived or actual, in terms of the share market and the economy over the very short term. And the reason for that's very simple. We don't think we have an edge in forecasting share market outcomes over the next 1 to 3 months, for example. What we tend to focus on here is a longer term time frame, let's say 6 months to 24 months, where we think there is some ability for us to move money between shares and bonds and cash and other assets. For me, the response between COVID-19 and the economy and what we're going to see in share markets is quite stark, but it's important to pay attention not to those top line figures, and I'll refer back to the chart I showed from Goldman Sachs looking at value versus growth. It's a really hard thing to do for anyone to forecast what the share market's going to do over those sorts of time frames. I'd simply suggest that if you're in need of some advice, that you should find a trusted advisor, and again, whether that's from us here at LGIAsuper or somewhere else, we'd love to sit down and talk with you about your issues. Thank you.
Thanks, Troy. I might just stay with you. We've got one more question we take here from Craig, and Craig asks, the default investment for most members, as you mentioned earlier, the My Super under 75, I think if we talk to that one, the question is sort of where is that focus between aggressive and defensive on that sort of range?
Yeah, it's another great question. Thank you, Craig. If I contrast our My Super option compared to the options that sit either side of it, we talk about a growth defensive asset split. So about 75% growth assets here in My Super for the under 75 component. Aggressive sits at 88 and the balanced at 55. Now, compared to that long-term strategic allocation to growth assets, and again, purely from an investment point of view, I'm not licensed to provide personal advice, we're currently a little bit underweight. We're on a more conservative side of that 75%. We think it's a time to be a little bit less exposed to the share market in particular, and we find bonds to be very challenging investments. As I said earlier, bonds now give you a negative return after inflation. We think it's appropriate for people to be conservative given the uncertainty in the outlook, and again, I'll reference people back to that chart I showed showing the ratio of the prices that people are paying for $1 of future earnings. We think those prices are now quite elevated, and we're justified in taking some money off the table and investing it elsewhere.
Excellent. Thank you, Troy. So we might keep moving through. We will have time for some more questions at the end of the evening. Again, if you've joined us since the start of the session, thanks for joining us. If you do have questions, there's a little blue hand icon you can use to type and send us questions. So now that we're all investment experts, let's look at the other side of the coin, and that's the contribution aspect of contributing to super. There's two main types. There's after-tax contributions and also those which you get tax benefits from. So we'll start with the tax-effective type. Before I move through into it in too much detail, just a slight overview of tax in Australia. And apologies if you're well familiar with marginal tax rates, but I find it's not always commonly well understood. So to illustrate super, I've chosen the main income bracket of Australians, and that's between $37,000 and $90,000. And as the image shows here, in that band, we pay 34.5 cents in the dollar for income in that after any deductions. If we earn more, then you'll also pay a higher rate of tax on income above that, or conversely, if you have lower income, you might be paying less or no tax. However, in the superannuation environment, the tax rate is only 15% on money coming in there. So to us, that illustrates why super is attractive. It's really all super is a set of tax rules. So for most Australians, with their level of income, there's potential advantages by paying a super rate of tax as opposed to their marginal one. So let's look at an example. So what if someone in this income band chose to or looked at $5,000 that they earn as income? If they just earn that as normal salary, they'll pay $1,725 in tax on that money. However, if they choose to have it to go into super instead, and a common strategy for that or term for that is salary sacrifice, and again, many of you have probably heard of that. If you haven't, it's simply you directing your employer to divert salary to the super company before paying it to you as tax, so it therefore gets taxed at the super rate instead of getting added to your taxable income. So in that scenario, $5,000 is now being taxed at 15% instead of 34.5%, so $750 tax, which is about $1,000. And I don't know about you, I'd rather have $1,000 in my super, I think, than sending it off to Canberra. And we don't use that to say 5,000 is not the magic figure that's going to get you that comfortable retirement. It's purely there for illustration purposes. But let's look at how it can work. So if we go back to Jack, at 60, Jack decided, well, he heard all the guys at work talking about salary sacrifice, so he thought, I can afford 5,000, I'll put 5,000 in. So with 200,000 in super at age 60, if he had have made no changes to his standard employer and personal contributions, it would have grown to roughly 270,000. But by doing the extra 5,000 a year for 5 years, he's now got nearly $22,000 more in his super. And the good news there is roughly 5,000 of that is money that was saved from the tax man. And really one of the other main benefits or reasons that these outcomes are achieved is really the fact that you couldn't access it. And while that's often seen as a negative with superannuation, really that's one of its strengths, the fact that it can't be touched. Obviously, present environment accepted. Now, unfortunately, the government doesn't want us to enjoy this too much, so there are limits. I'm not going to spend much time on this slide. The key message is here, currently that concessional limit each year, concessional meaning the amount that someone gets a tax benefit on, of $25,000. But the important thing I want to point out is it does include not only any salary sacrifice or deductible contributions you make yourself, but also any that your employer is making. So you can't just add and think, I've got 25, you need to factor in what's being paid for you. But having said that, there is some recent good news in the super world around contributions, and I just want to take you through that now because as advisors, in particular, we get quite excited at the prospect of using this for our members over, right now and certainly into the future. And so we'll use this example. One important point here, though, is unfortunately it is only able to be utilised by people who have what we call total superannuation balance of under 500,000. So that means the total of all money you've got in super, whether that's in an accumulation account or a pension account or one or more super accounts. So you must understand that if you're under 500,000 at the start of the year, then this may be available to you. So let's work through this example. Let's say in 2018-19 financial year, so I had that $25,000 threshold and the contributions I made in that year were $10,000. Well, previously that would have been lost, but now that $15,000 can actually get rolled forward to the next year. So in 2019-20, I actually had another $15,000. So a total of $40,000 that I could have contributed to my super and got tax benefits in the 19-20 financial year. Now, I wasn't aware of it and I didn't really have the cash flow to do it, so I still only made contributions of $10,000 in that year. Well, now I've got another 15 to roll forward, so a total of 30 that I've carried forward, plus my 25. So now in the current financial year, I've got 55,000 available to me to use, and I choose to do so this year for whatever reasons, or to save tax is obviously the reason. And the good news with this is that it can accumulate for up to 5 years. So there's a real opportunity to utilise this. So if people are out of the workforce possibly for a little bit of time, it can accumulate when you're back and maybe on higher income to really use some strategies to address it and get the best outcomes that you can. So if we go back to our salary sacrifice example, what if we were able to make a more significant contribution? Let's use 25,000 as the example here. So on that 25,000 that I earn, again, that same income band of 37,000 to 90,000, on that 25,000, I'm going to pay $8,625. But if I move it into super and get the super tax rate, I'll only pay $3,750. So in this example, just under 5,000. And while this is just an example, my team were only just talking about this in the last week of a recent piece of advice that we've put together for one of the members using this very strategy. And the tax benefit in the first year was actually just a bit over $5,000. So it's a real strategy, and I encourage you to make sure that if it's available to you, that you don't miss out. So if we look at what can that look like in terms of converting that to a strategy, so we'll go back to Tom and Sophie. So at 60, they had 400,000 in their super. One of them was working. If they just continued for those 5 years, that super would have grown to 482,000. Now they've thought they became aware of the catch-up contribution, so they decided to do that in the first year. And then continue on targeting the cap or the 25,000 each year for the remaining 4 years. So in that case, that saw their super grow by an extra $63,000. So pushing them a lot further down the road into that comfortable retirement, basically an extra year's worth of income in retirement by adopting that strategy. And the best part again is $15,500 that was basically saved from the clutches of Canberra. So real benefit of maintaining or keeping more of your money for your retirement. Now, I guess I'll use that example of 25,000 for you. You might be thinking, yeah, great example, John. Everyone's got 25,000 lying around. Well, let's look at how there might be strategies to help you take advantage of this. Well, first of all, what's the typical income situation? So I'm sure you'll be able to relate to this. When we're working, that income comes in and it has to go in certain places. I've already been talking about the tax man, so unfortunately, they get paid first. Now, I've also mentioned earlier about these fixed expenses, so we definitely all have certain expenses that are unavoidable, and we should be allocating adequate funds for that. Now, the next bucket we've got here is the fun bucket. Obviously, well, it's important to enjoy life, and that's been quite challenging and continues to be for many people at the moment, and hopefully that doesn't have to continue for too much longer. But I guess I'm a bit of a mean financial planner too, so I'll usually sort of point the finger and say, yes, have fun, but don't have too much fun, because there's also a fourth bucket, and this one often gets forgotten, unfortunately, and that's the future bucket. And that might be definitely contributions to super would fall into that category, might be additional payments to reduce loans or mortgages and the like. And unfortunately, certainly I don't want to kick anyone while they're down, but I think another thing that this pandemic has really highlighted is, unfortunately, because we've experienced 30 years of great employment and growth and no recessions in Australia, I think we became a little bit blasé about the importance of preparing for a rainy day. So I really can't stress how important this aspect is of making sure that, yeah, enjoy your life now, but position yourself well for the future. And look, this is where super can play a part. So some of you might have heard of transition to retirement, and I'll just explain that a little bit for you now, because again, that's the other thing that us advisors get excited about, especially for people once they reach age 60, and that's what I'm focusing mainly on tonight. Now, some people can access it before 60. If you're born before July 1964, you'll be able to access it prior to age 60, but there's a different tax treatment. So it's important to be very mindful of what you do in that situation. Oh, it's always important to be mindful of what you do. But for our examples, we're talking about people aged between 60 or from 60 to 64, really. Because now we can access, I'll take you through that in a moment, and we can actually access our super at that point in time, even though we're still working, and use it for different reasons. Now, what might those reasons be? Well, maybe to make those contributions into super, to get those tax benefits, and effectively a sort of a recycle strategy to take advantage of these tax savings that are on the table. Also, maybe you want to work less. Funnily enough, in the mid-noughties when this legislation was brought in, really that was the whole concept of it. So rather than people having to go from full-time work to no work, to give them this ability to scale back, maybe go to 4, 3 or 2 days a week, and be able to access their super enough to top that up so they can still get the income they need, and thus the terminology transition to retirement. Now, in addition to that, a strategy we do use it sometimes for, hopefully you're watching and you've got your mortgage or so forth under control, but it's not uncommon for us to still see people who might have some mortgage or have some other retirement preparation they want to do and needing funds for that. So again, it could be used for those type of purposes. And lastly, estate planning. I'll come back to that one. Come back to that one in a moment. So what does it look like? Now, while we're working, super basically looks like this. You've got a relationship with your employer and they pay the contributions that they're obliged to pay on your behalf to the super fund, and you might, as I said a moment ago, you might direct them to make additional contributions on your behalf, either through salary sacrifice or from after tax even. Similarly, you control your bank account and you might choose to make your own contributions into super as well. So pretty simple when you look at it like that. So what happens with a transition to retirement? Well, importantly, nothing happens with the relationship with your employer. So they're still there, we just grey them out a bit. So all that continues on as normal. But effectively what you do is you take a big chunk of the super that you've got in what we call the accumulation account and create this new pension account known as a transition to retirement account. And that then creates, that's how we can access it. Basically that's what they're about, is giving cash flow. So you'll notice on the slide there we talk about a minimum and a maximum. So there is a range within which you can access funds once you create that pension account. And again, remember in this example, really talking between 60 and 64. And those minimum and maximums, they get reset, so they've just been reset now, 1st of July, for the next financial year. And again, as the image shows you, the LGIAsuper will pay that pension payment or payments on a regular basis, depending on how you want to receive it, into your bank account. And you then control the use of that money. As we've shown here with the dotted line, you might use that for those contributions back into your super account to get those tax benefits. Or the other box, as we said, debt repayment or other plans that you've got. Now, I do want to definitely throw a big warning out at this point, because effectively you are accessing this money, which is your retirement nest egg. So if you start one and just use it for a cash hit prior to retirement to really overflow that fund bucket, then that could have really serious implications for you down the track into retirement if you've used it too soon. So definitely you want to take that into account. Now, if I touch on this estate piece a little bit, or go back to Tom and Sophie. So if we think of Tom and Sophie, they had $400,000 in super when they were 60. So they could have started a transition to retirement pension with $400,000. So in that example, minimum, maximum, 4% minimum. So they could have drawn, or would have had to, in that example, draw at least $16,000. But they could have drawn as much as $40,000 in that first year. So again, that catch-up contribution idea we talked about before, well, hey, in this example, that's $40,000 that could be used for that purpose. So we could really fund some significant tax savings by going down that road. But what about the estate? So I'll touch on that quickly, because it is an area we find we're doing more and more advice for members, and it's not a very well understood. So most people now know that once I get to 60, I can access my super without tax implications, which is clearly fantastic. And if you're a member of a couple and you pass away and it goes to a spouse or other what we call tax dependents, then there won't be any tax to pay at that point either. But behind the scenes, most super accounts, especially while you're working, are going to have what we know as a taxable component. So even though you won't pay tax yourself while you're alive, depending on who that money, if there's still money in your super when you pass away, depending on who it gets paid to, there may be tax payable at that stage. So what we can do, part of this strategy, so maybe, again, that same example, $40,000 available to us, because we can receive it tax-free at age 60, or maybe I want to take it out and change it from, now it's not taxable money, and I can put it back in as what we call a personal or tax-free contribution. It doesn't get taxed again on the way back in, and therefore changing it from money that tax would be paid to maybe the adult children or grandchildren to being tax-free. And like I say, when we talk that through with members, it's very common that they'd like to improve that outcome if they can. So So the first step to understanding what the nature of your accounts are, how old you are, and all those things factor into whether that's an opportunity for you or not. And clearly, we're happy to help. So moving through, in terms of those type of contributions, personal contributions, there are limits on that as well, $100,000 a year. There is what we call a bring forward rule, which can allow up to $300,000 being done in 1 year. Again, there are some rules on that. It's a little bit of a moving feast at the moment. There's some legislation, some has been passed and there's some still waiting to be passed. So for people over 65, definitely check in if it's something you're looking to do. Also, there's a newer opportunity, and clearly you're all too young to worry about this at the moment, but if you're over 65 and selling your home, there's also the opportunity to get some of those house sale proceeds into super, with what we call a downsizer contribution. So we won't go into a lot of detail now, but there is quite a bit of fine print with that. So if you are over, or when you get over 65, you think of selling your house, definitely want to do your homework first, because you need to make sure you go about it the right way. All right, well, let's take a breath. We've thought about retirement and preparing. Where's the money going to come from? So if we just move through that area now, generally, most people retiring right now, who are at their age pension age, will qualify for some age pension. That's still quite common. And so it still really is the cornerstone. And as you can see with our pyramid here, superannuation generally is the next layer that gives additional income. And then you might have some other deposits or shares or property or some other investments that also might supplement or top up that income. What about the future? Well, look, we don't really know, of course, but I'll be surprised if, with the way things are going with superannuation and future growth in that area, I won't be surprised if that becomes the more significant cornerstone or source for people in retirement. Now, having said that, there's certainly some people we talk to think, oh no, the age pension's going at some point. Well, no, there's no legislation or anything that sees the age pension going away. The government's always talked about it being an ongoing safety net and in existence. But definitely as wealth accumulates and grows, the significance of that may reduce. And look, as I said earlier, I like the idea of aiming for self-funding. If the super can be the whole pyramid, for me, great outcome. Why? Because you don't have to worry about what the government's doing and what changes might impact your lifestyle. So control the things you can control, put yourself in the best position. Absolutely, as an advisor, if we can structure things to get a better outcome for you, then obviously we're going to do that for you. So again, these numbers will be in your workbook, so you don't have to jot them down. Just wanted to sort of touch on what is the age pension or how valuable is it at the moment. So you can see here for a single and a couple. And this is the maximum rate. And one point I do like to make here, right at the start, we talked about modest and comfortable lifestyle. And I'm not sure how good your memory is, but these numbers are actually quite similar to a modest. I think for a modest it was about $28,000 for a single and just over $40,000 for a couple. So hopefully, if nothing else, after joining us tonight, you go away and know that most likely, if you're a half-decent super balance and the opportunity to grow it, you've most likely got a modest retirement in the bag. So the question is probably not, can I have that? It's how far into the comfortable zone do you want to get yourself? And how much you get is based on what the government does call means testing. And again, it's based on assets and income. Whichever one gives the worst outcome, unfortunately, that's the one that applies to you. And as I say, some of those details are in the workbook for you. So if you're closer to retirement or closer to your age pension age, definitely that'd be well worth investigating. Now, we're close to bringing things to a close. When we actually retire, super can get a whole lot simpler. Why? Well, in terms of what do we need our money for, good news is tax bucket can go away. If you're all or the majority of your assets are in super, as I was saying before, a lot of times we do a return for someone when they retire, an advice for someone when they retire, and they know they're about to do their last tax return, which is a pretty good feeling. And so now you just have your fixed expenses and those fun expenses. And so the future is now, so we've taken that bucket away. But again, you can't have too much fun because that could still have jeopardy or jeopardise the longer term. In terms of super, it can be as simple as converting all the money you've got into super into a retirement pension account, pays you that regular income and you enjoy yourself. You'll see here that now there's only a minimum, so once you retire and over 60, retire, start a pension account, there's no limit. So there's a minimum you have to take, but there's no maximum, and that includes lump sum withdrawals. So very simple like that. What Troy also, in terms of payment, what we find is most people, because they're used to getting paid weekly or fortnightly through their working life, so the pension can just replace that. Every fortnight you can have that money hit your account. So maintaining what you're comfortable with. And as Troy mentioned earlier on when he was talking about returns, that's the second key benefit of a pension account, besides getting income so you can live, is once we move into a genuine retirement pension, the earnings are tax-free, which gives us that opportunity to get even a better return on that money for many years in retirement. And I guess in closing out that, so one thing I should mention there as well, sometimes there might be a reason why you wouldn't want to start a pension, so I'm not just automatically saying once you hit these points in time, that's what you should do. The main reason not to is typically linked to possible government benefits, especially with spouses where mum might be a few years younger, or if you're single and maybe entitled to some disability benefits through the government. So it's very important to understand how that interacts with the government, and again, we're very comfortable helping you with understanding that. And so I often say I've been working in super for over 30 years, so if anyone's brainwashed about the value of super, it's me. But if anyone can tell me how you can accumulate $1.6 million in an environment and have it invested completely tax-free, I'm all ears, but I'm not aware of anywhere else, certainly nothing legal, that you can do that. And if you're a couple, guess what? That's $3.2 million. So I think that's a pretty good goal to have, or something to aim for. Now, as we start to bring tonight to an end, again, thanks very much and congratulations for getting to the starting line and being proactive and engaging with your super. Remember, visualise that retirement. What do you want it to look like? Understand how your super is invested at the moment, and then consider what opportunities are available to you. Don't wait and think, I'm retiring in a couple of years, I'll see you then. So we've got a little bit of time. We might just try and take another question or two before we bring it to a close. Okay, so Gillian asks a question of, regarding the contribution catch-up, can you contribute on behalf of a partner? Good question, Gillian. I don't want to give you the wrong answer, but the short answer, I believe, would be not really. It's based on your salary, your income, your contribution caps. So you need to be able to meet those. You need to be able to meet those criteria and be able to make any catch-up contributions into your own account. Now, there might be the ability after you've done that to do some splitting, which means it goes into your account first, and then you might be able to move it over to your spouse's account after that point in time. So, maybe, sorry to sort of be on the fence there, but definitely that's getting a little bit detailed and well worth investigating your own circumstances there to understand. Now, I think we could probably go one more question here. A question from Julie. Thank you, Julie. Yes, so the question Julie asked is, I assume you're basing these retirement standards on the fact that you're a homeowner. So yeah, I should have clarified that earlier on. So yeah, those funding figures we did base on, effectively based on being a homeowner, or unless they would still apply if your rental income was included in that 62,000 for a couple, or 44,000. But most, yes, generally those figures would be more homeowner based, and definitely you'd need to factor that in. Similarly, the age pension thresholds that you'll see in your workbook, those tests are based for homeowners as well, but there are different thresholds for non-homeowners. So again, that information is readily available through Services Australia website, or we can help you with that as well. So yeah, sorry for not being clearer on that. And with that, I think it's probably appropriate that we bring it to an end, because we're getting over the hour mark now. So thank you for staying with us. Look, as we've said, there's a lot of information we've covered, and hopefully that's clarified a few things for you. It's no doubt probably created some more questions for you as well. And so we definitely want you to know we're here to help through our call centre or growth team, and certainly the advisors who work with me are here to help as we've been sort of alluding to tonight, super is a simple concept, but it's far from simple once you really dig in and want to uncover all the opportunities. So I think, again, as an advisor, I'm biased, but to me, good advice is so valuable in so many ways. It helps you stress a lot less through volatile investment times. I know all our advised members really valued that relationship and helped them get through earlier this year. Helps you protect, like we've talked a lot about tonight, protect your money from the tax man. Hopefully, help you know when you can afford to retire. There's nothing better than going to work knowing that you're only going because you want to and not because you actually think you're still a slave to that pay packet. How to structure, like I was just talking about a moment ago, how to structure things to maximise government benefits. We can get some fantastic outcomes for members in that regard. And most importantly, just help you look after yourself and your family in that financial aspects, both now and into the future. So we've got the services to help. Our advice team, obviously there's still a lot of concern with face-to-face and so forth, but we're happy to do phone and video appointments, so there's no need to put it off, no need to wait. Get in touch now. We'll survey you. We'll send a survey with that workbook. We'd really encourage you and appreciate it if you could fill that and give it back. That gives you the opportunity to let us know if you'd like to be contacted about advice, and as I say, let us know how you found this evening. So with that, Troy, anything last you'd like to say?
Thanks, John. I know it can be a scary time for members watching financial markets, but the best single thing that members can do for themselves is to continue to ask questions. And again, the folks here at LGIAsuper would love to help. So whether it's clicking on the little blue icon at the top of your screen this evening or sending through a question, reaching out through the contact centre, please get in touch. We'd love to help. And thanks again for your time.
Great. Thanks, Troy. And look, thanks everyone. Keep an eye on the inbox for the email, and all the best. Thank you.